Any advice and information from this podcast is general only. It has been prepared without taking into account your individual circumstances and needs. Before acting on any advice from this podcast, you should assess and seek advice on whether it is appropriate for your needs, financial situation, and investment objectives. And we are back, ladies and gentlemen. Hello, J-Mac. Let's pretend for the thousands of listeners out there, this is like another day. So it's not raining, but it is. No, that's all right. No, we're back, ladies and gentlemen. We are now on to episode 2 of investments. We did the intro last time, which covered, I guess, overall a few considerations. The big question was the why. Have you figured out your why yet, J-Mac? What is your why?
Well, like you said, I want to drop back from one day of work to maybe a few hours. No, I wish.
What the hell, man? Are you saying you're a better investor than me?
No.
I'll figure something out. How to get from working 7 days a week down to 6.5 days a week.
We work Yannick hard at Evergreen.
That's why I have to crawl to the car park after a day's work on the keyboard. My brain. All right, ladies and gentlemen. So essentially, episode 2, we're going to take you through, I guess, the more traditional investment types that are out there, and I guess what they mean, a bit of a broad overview on them, nothing too deep in the rabbit hole. We'll only sort of go halfway down, just to try and highlight most of the ones you most likely would have heard of, whether it's, through friends, having a chat, reading on the news, watching the news, and we can sort of go from there. But buckle up, though. There's going to be a few episodes to this whole investment piece. But this one could take a little bit longer. And as you can tell, I'm a little bit excited. So we can kind of go from there. Okay. So, Jessie, we're talking about investments, and I guess the traditional investment types come to mind. Do you have sort of a few of them off the top of your head? Like, what are they? What are your more traditional investment types?
Yeah. So I guess obviously your savings account, people put a lot of cash into savings, just your standard kind of bank account.
Well, it's a type of investment, isn't it? You're putting your money somewhere as opposed to under the mattress.
Yes.
I thought that was a good thing, the mattress idea.
Yeah, well, it feels fun to kind of sleep on your money, I guess, but you don't earn interest.
Oh, yeah, you don't. Okay, yep, go.
Then there's the other kind of obvious one, real estate.
Yeah, we touched that on our, should we call it first season or first series?
Yes, first series.
Yeah, we're going to outdo Game of Thrones here. We're going to go for like 10 seasons or something. Anyway.
Whether or not that anyone listens, but we'll do it.
Yep.
Real estate, obviously, people buying investment properties, that's a topic. It's kind of general for people to talk about that one. Next one, shares.
Ooh-wee. That sounds scary.
Yes. Everyone's usually a bit scared of that one, but we're going to make it less scary.
Let the debunk begin.
Series. Yeah. Bonds.
Yep.
Yannick is the master of bonds.
A little bit of knowledge, but we'll definitely sort of cover off on it because it definitely fits into everyone. Most likely, most people out there have a little bit of money somewhere in bonds, whether it's most likely through their super, potentially, but we'll definitely cover it off. Yep.
And then the last one we'll talk about is managed funds.
Okay. Okay. So is that sort of like your all those investment companies you see, whether they're, you can buy into managed funds. Okay. Yep. We'll sort of cover off on those. All right. So with investments, is there a bit of a difference between like the ones you just outlined? There's real estate and shares, and then there's bonds. You talked about the savings account. Are they, I've heard sort of those words get thrown around like aggressive or growth versus kind of your defensive. What are the differences there?
So your defensive is typically ones that provide you a stable kind of income or income stream.
Okay.
So like your savings accounts, at the moment you might get a 4 or 5% interest rate.
Yep.
That'll obviously go up and down with interest rates, but you're kind of guaranteed that at the end of the month.
Yep. And is your money pretty, look, with most banks, I'm just sort of relating it to Australia, most banks are pretty rock solid. So if you had 100 grand in a savings account earning 4%, and when the next GFC rolls through, let's just say while we're doing this podcast, Trump and Putin meet up. Trump gives him a little, as we call it in Australia, a shirt front or a bit of a slap, and the markets absolutely melt down. Will my 100 grand still be there in my bank account?
It will.
Right. Yeah. So with that, with savings accounts in Australia, it's pretty much guaranteed. The government will guarantee up to 250,000 in a savings account. If that bank goes under, they'll essentially guarantee that that money for you. So that's okay. So that's the defensive one. What's like a growth one or an aggressive one?
Well, they're more, I guess, shares.
Oh, okay.
Obviously, they sound scary, but they're mainly focused towards, investing in companies that are quite aggressive and, the ASX or S&P.
So like indexes, yep.
Yeah.
Okay.
Things that are more aggressive or likely to get you more of a return.
Right, in the long term, you mean?
Yes.
Yeah, so there's a bit more volatility with them.
Yes, exactly.
Ah, okay. And I guess the one I know you're good at explaining is if I put my money in a savings account, yes, I'm getting that 4 or 5%, but is it like the share price where it can increase in value, or is it just the interest I'm receiving?
Yeah, great question. I guess with interest or, savings account, you get the interest factor.
Yep.
With, shares or managed funds or whatever you invest in, there's usually the dividends factor, which is, the profit between all the companies divided between the shareholders, which would be you if you're investing in shares.
Yep.
And then there's also the growth factor. So the companies like Apple or Samsung are bringing out, what are we up to? iPhone 17 coming soon. I don't know.
Yep.
They're always growing and...
like share price value.
Yes.
Okay. I guess the one that springs to mind a few years ago was Afterpay. It was like this little kind of you'd call it a bit of a unicorn, little startup company, tech company in Australia. Its share price, I think in 2016 was a couple of bucks. And then it exploded due to how Afterpay works. It's become part of our vernacular in Australia. I'm just going to Afterpay it. Whereas when I was growing up as a teenager, it was put on lay-by. Anyway.
Oh, lay-by.
Yeah, you'd probably too young to understand that bit. But that's sort of that's the growth you're talking about. Okay, so money in a savings account, they'll only pay you interest. Is that right?
Yeah.
Yep. But whereas if you've got money in shares, potentially you will receive dividends and potentially there's potential for like share price growth or, okay. And then you talked about real estate, which we talked about in our last series, but similar things apply. You're buying, say, a house or a unit.
Yeah.
You're renting it out. The cash flow is sort of negligible, depends on how much you have to borrow, but it's paying you, I guess people are paying rent. So you're receiving some income, but as well as that property value is most likely growing. Is that right? Especially when you're talking about, I don't know, your capital cities. But I guess the difference is, we'll get into the differences later, and we talked about real estate. You can't really buy real estate with like $1,000. Well, sort of. We'll talk about real estate investment trusts in a second. But
yeah.
Okay, no, it's really interesting. So you were talking about shares before. You talked a few things on how they work. And like you talked about the Tesla thing, and I think as we're talking now, you talked about the company Tesla, and I think that's taken a little bit of a slap on the share price. It was literally only maybe a few months ago or whatever, within the last 12 months, it was like the most valued company in the world, or the richest company essentially, but now I think it's gone down a little bit. There's other companies have taken over. Is that what you mean? So like the Tesla share price plummeted lately, or?
Yeah. Well, what's today? The 19th of
March. Yep.
Everyone knows what's going on at the moment with Tesla in America.
Ooh.
Just having a look today, the share price has gone down 5.34%.
Just today?
Just today.
Oh, okay. Yeah. So that's just an example there. Okay. So that's where you're talking about that volatility side.
Yeah.
Yep. Everyone's happy. Winners are grinners when the share price is up. But as you know, say with shares, there's that volatility there in the short term. As Jessie just outlined, literally in today's trading on the US markets, Tesla shares went down 5%. So that's something you won't get in your savings account. A savings account will essentially pay you that interest rate over a year. You know, if you've got $1,000 in there, it's not going to be worth $900 tomorrow because of any other reason. You're going to earn interest daily and get paid monthly. Yeah,
You're
okay.
right.
That's
The main difference being the volatility.
yeah, right. And with just touching on dividends again, that's a question I definitely get asked a bit by a few clients when we deep dive into shares and what they are, and we sort of outline, well, there's some companies out there that pay a dividend. What dividend again? Run it by. Remember, you got to break it down to the Fitzy level. Even though I'm, financial advisor, fair bit of experience, but give it to me on dividends again.
Yeah. So essentially, what happens with a company? Let's use maybe a one we know in Australia. BHP.
Commonwealth Bank is probably a big one, biggest bank in
CBA.
Australia.
Yeah,
So do they pay a dividend?
they do. So a lot of companies pay it a dividend maybe quarterly.
Yeah, or biannually. Okay,
They're all
yep,
different. Yep.
Yep.
But say it's paid quarterly, so they'll work out between those quarters their kind of profit for the quarter, how have they done, and they can choose whether to distribute their profits with the shareholders.
Okay. So if a company, let's just use the banks as an example because everyone's got a loan with the banks. So Commonwealth Bank, they make buku profit in the year, or as we like to call it, buku bickies in the year.
Bickies.
Add a dollar sign to it. So they make a heap of profit. Do they have to issue dividends to their shareholders?
No, they don't have to.
What are they going to do? Are they just going to keep the money?
They're going to keep it.
Okay.
See how they feel, yeah.
Yeah, well, look, there are some companies, so not all companies, when they make a profit, issue dividends. Some companies, especially if they're newish or looking to invest within their company again, they'll use those profits to try and generate more profits. So they might spend an extra 100 or 200 million on research and development. Think of Tesla many, many moons ago. For several years, they were operating as a company. Tesla made no profits. They were running at negative. That was in the infancy when they were just building their cars, getting, I guess, their sales and their manufacturing down pat. They were, whatever profits they did make, they'd reinvest in the company. And now look at them now where they were, they got to a stage maybe a year or two ago where they were selling a heap. Okay, so companies can essentially either invest in themselves or issue those dividends out to shareholders. Okay.
And what did you find during COVID? Yannick, did you find that they paid out the dividends?
During COVID, I was too busy buying toilet paper like everyone else in Australia. Is that right?
Great answer.
COVID was very unique, and not to say COVID will happen again. Something like that may happen. Who knows? But there were still some companies that were generating revenue and running at a profit as well. Some of them might have held on to their dividends or not issued dividends for a small period just to let the smoke settle on the financial markets. And then you'd see some of these companies, let's just say CBA or Commonwealth Bank of Australia, were back to what they do best, making money. Once they'd sort of build up a 6 or 12 months of returning the profit, then they were back to issuing dividends to their shareholders. And especially in Australia, they're really, Commonwealth Bank, not to say that you should go out and buy these shares, this is just a general outline saying that they have a consistent track history of issuing dividends to their shareholders. So I guess retirees kind of like them because they're consistent. They provide an income to the shareholder via a dividend. It might only be small, but it's better than nothing. It could be 3, 4, 5% a year. We'll talk about the franking credits that come with that later on. But at the same time, you would have seen if you, for all our, have we gone to the millions of listeners out there?
Maybe
for
later.
For our 7 listeners out there, Google Commonwealth Bank Australia share price, and you'll see over the last couple of years it's done quite well. A few years ago it might have been around the $70, $80, $90, but now I think it's floating around the 150, 140. I should have a look. J-Mac's doing the research as she does.
144.
Yep.
Well done, Yannick.
Yeah, so that's just an example of company issuing dividends and a company experiencing capital growth in their share price. If my parents had pulled their act together and bought me Commonwealth Bank of Australia shares when they released in the 90s, what did they float on the ASX? A couple of dollars?
$19.99.
And how much were they?
$23 a share.
Oh, thanks, mum and dad, wherever you are at the moment. Yeah. Yeah.
They just raised you.
Yeah, whatever.
Yeah.
Crack on. Okay. So that's sort of, okay, thanks for that. You've explained sort of the dividends wise. And that sort of comes to, the company performance short and long term, because not every company's share price is going to go on one trajectory. There's going to be a fair bit of volatility in there. Jessie, you talked about like COVID. There could be news, especially the last 2 weeks. We go back to that again, where there's been a heap of Trump with his sort of new tariffs that are being implemented, the Russia-Ukraine war. That's creating a lot of volatility in the share markets at the moment. And there's a few of our clients we've had to, as we mentioned last episode. So the offer's still out there. If you need a bit of a cuddle just to chat about recent share prices, come on in. I'm booked up with hugs, but Jessie's maybe, or the other guy we might know who's got half an idea called Roshan, he might give you a cuddle, but sorry for another time. Okay, cool. All right. So the other thing I want to highlight with shares, I think you mentioned, are you saying that most people, whether they know or not, have probably got some of their money in shares? Is that right?
They do.
What? I never signed. No. Okay. Yeah. Please explain.
Well, I guess superannuation.
Oh, that's your retirement savings.
Yes.
Yes. Okay. Yep.
When you think about superannuation, I guess that's the government's way of trying to get you to save for your retirement.
I thought they were going to fund it through some sort of age pension or
I
something.
know. I think they might be trying to, in years and years and years, not have to use that anymore. But I think if you think about superannuation, it's $1 billion industry.
Trillions, I think.
$1 trillion industry.
Yeah, Australian superannuation gross assets and funds under management, I think it's in the trillions. It's massive, especially a country that's only got 25, 28 million. We're, I guess, a big player out there.
We're
through
wealthy.
Yeah, like just off the top of my head, I think Australian Super's the largest. I think Australian Retirement Trust is second largest. I don't know who's coming third. Maybe Fitzy Investment Fund. No,
You can
maybe
get in
not.
there, yeah.
Okay, so yeah, I guess look, if you're driving in your car, stuff it. Might as well just jump on your phone, have a look, tap into your super account online and see. You might have some of your super funds invested in shares. Is that right?
Yeah.
Okay.
And I guess by default, they put you in, say, a balanced investment.
Oh, yep.
And you know what you were talking about before being, defensive versus growth or aggressive?
Yep.
The majority of your portfolio in super is generally invested in, say, Australian and international shares. So if you have superannuation, you're most likely already invested in shares.
Right. Well, there you go, ladies and gentlemen. As usual, Jessie outlines the facts that pretty much everyone in Australia that has super or otherwise will have a couple of dollars at least invested in some shares in some way, shape or form. So everyone, you've got flesh in the game in the share market. Well done.
Congratulations.
Hey, well done. Okay, cool. Thank you for that. All right.
Yannick, so talking of volatility, what kind of dictates day to day? What happens, say, with the Tesla shares, like the price goes up and down, or Commonwealth Bank, the price goes up and down? You see it maybe go from, what was it? Commonwealth was maybe going from $135 a share to $140 a share, maybe up again, maybe down again. What kind of dictates that?
Okay. So, volatility. I thought the Dummy's Guide to Share Market was buy low, sell high. Is that just how it works?
Yeah.
But how come? Yeah, no, I know what you mean. So yes, you can definitely jump on the news, and sometimes it's international events, geopolitical, economical. But when we talk about share market hype, sometimes you will find, without going into the analysis of these companies and how their financials are, sometimes a company might be well overpriced, and when it's saturated all over social media or the news, you're like, oh, why is that company exploding so well? Maybe I should just jump in and buy some because they're going to keep going, right? That's not always the case. Sometimes there's a heap of media and market hype. Think of what was that company that happened in the US? It was the small gaming company. a heap of guys on Reddit or a heap of people on Reddit. GameStop. So that's your example. Thank you, Jessie. As a side note, our other nickname is Jessie and I are usually called the diamond in the douche. She comes up with all the good quality stuff, and I'm just
Quite the opposite. No.
here moving the mouse around. But GameStop, that's very similar to sort of like market hype. Everyone jumped on the bandwagon, regardless of that this company wasn't really performing that well. Like, its profit, its net profit, its revenue, its costings, and all that weren't as good as other, or wasn't running as efficiently as other companies. Yet its share market exploded through the roof. Some people made some money, and a lot of people lost out big because they were buying on the way up. Share prices just then fallen through the floor, and some people are left with, potentially thousands of dollars of these shares that are now, they might have bought them at $100 a share, and now they're worth $10 a share. Similar to what might have happened in like the GFC or during the COVID. Okay, so
what's happened? Everyone's been talking about it, maybe at a barbecue or a family get
started
together.
from there, yeah. I think, look, the GameStop thing was more so it was on sort of like your Reddit chat groups where they were going to try and punish some of the short sellers in the big markets in the US, and it sort of grew from there. But yeah, there is a case where you can see things on the news or on your social media feed. You won't really dig into, I guess, the fundamentals of that business and just buy it on hype. Sometimes it might work out, sometimes it won't, and you might get left. And to be honest, I've experienced that on my little sort of travel on investment wise years ago, learning about shares. I might have got into some sort of small industries and companies that I thought were going to do well, saw their share price really sort of ramping up and thought, if I don't buy in now, I'm going to miss the boat here. Next thing you know, I've bought a few, and then next minute, fast forward a few years, those companies haven't performed that well, just due to, I guess, the product they were selling, the way they manage their money, and now they're worth a lot less. So, consider that as a bit of a lesson, but that's sort of how the hype happens. Yeah, you might get a hot tip at a barbecue. I'd probably listen to Jessie more than me. That's why she only works 4 days a day a week. But that, you might have a mate who's got a hot tip on a share that's going to explode, and you jump in and buy it, and and it just doesn't perform that well, or it plummets through the floor. And then when you do further investigation, you're like, had a great sexy company name, but I don't know. Eskimos have already got ice, and this company was selling ice to Eskimos, and it obviously didn't do well. That's kind of the example on companies being overpriced or in that sort of that hype.
So be wary of people jumping in, I guess, to the market and hearsay, which drives up the price.
Correct.
And being wary that if it's overpriced, maybe looking at more the company financials and how they're operating the company rather.
Buyer beware. I guess. And the share market, whether you log in or have a look at, there's a fair few sort of platforms out there you can view share prices, market performance. The share price of a company on that day doesn't necessarily reflect the true, I guess, fundamentals or performance of that company.
Is that similar to like your house? The price goes up and down, but it's really when you sell it that matters.
Yeah, that's true. That's kind of similar with real estate. It kind of works in a little bit of a different trajectory, but it's a type of investment, where real estate prices can really sort of fluctuate or boom. At the moment, majority of Australia is copping that boom. Like real estate prices are sort of going through the roof. It's not to necessarily reflect that's the true value of a house, but comes down to a bit of demand and supply on that one. But interesting. So we've talked about sort of a little bit of real estate, what shares are, and I guess with shares, you don't always have to buy a direct share. You can also buy other things. Is that right? Like through a managed fund or an index. Is that right?
Yeah. So there's a few different ways you can do it, like a managed mutual fund. So you can, buy indexes or company or, mostly managed funds are, fund managers doing active investing, meaning they're, buying some Tesla shares, buying some CBA shares. And there's passive ones like, the index, such as S&P or ASX.
Is that what I see on the news? Yeah, a few people have asked me that. Some of our clients are like, I guess when we talk about indexes and they might see the news in the morning and go, oh, the ASX is up 0.70%. So people can buy that, can't they?
Yeah.
Ooh, okay.
I think the easiest one that people kind of start off with is, getting a ComSec account or a TMC account and buying some ETFs or exchange traded funds.
They've actually, funny enough on the ETFs, they've definitely hit the forefront in the last sort of several years. There's a heap of data out there on how the ETF and index funds market has just exploded. So if you think back to the 80s, 90s, maybe 2000s, managed funds were the bougie way of investment. Oh, hey, I got a fund manager who's buying me shares. Think of Wolf of Wall Street, sort of, my stockbroker kind of thing. So as a quick little outline on index funds in the US fund market in 2010, there was only 10% of the world markets, the US markets were index funds, and there were some ETFs, but nearly 80% were actively managed funds.
That's some good stats, Yannick.
I'm ripping this off some sort of bogus website, Fitzy's Financials faux pas. I don't know. But we fast forward to 2020, 2023, 2024, that demographic has changed now. Now it's only 50% actively managed by fund managers, and then, about 20%, 21% in index funds, and then 27% in ETFs. So the market is growing.
Yeah, right. And what's the main difference between, say, a managed fund and an ETF?
Right. So managed fund, think of, I guess, some of the movies you see, I'll take that back. Managed funds are essentially, there's different types. There's heaps of platforms out there, I guess, that let you buy managed funds. And as Jessie said, you can either buy passive index funds that just track an index, like the ASX 300 or the S&P 100, etc. Or you can buy an actively managed fund where there's a fund manager who's sort of actively trading through the day or week, buying this, selling that. They will usually come with a bit more of a fee because they're actively managed. I mean, that fund manager ain't doing that for free. He's got to afford his house in the eastern suburbs of Sydney or wherever. No, I shouldn't say that either. But you can get managed funds that are quite passive and just follow an index, and they kind of just track that performance. There's not someone there, buying portions of, this share or that share. So that's sort of how those work. Okay, and you talked about platforms wise. So you can essentially jump on and create an account and buy shares. Is that right?
Yeah. If you're thinking of, ETFs, I guess are the easy ones for the beginner to do, where you can just jump on, buy $100 or so worth of Commonwealth Bank or.
That's a big difference compared to, say, real estate, where we are on the investment subject. We talked about real estate. You can't really, to buy physical real estate, you can't really just jump in and start up an account and buy $1,000 worth of something.
Can't just buy a kitchen, can you, or a bathroom? You got to buy the
But
whole
with
thing.
shares, you're right. You can sort of buy, as you mentioned before, Commonwealth Bank shares, what are they, about 140, 150? So I could jump in and buy 10 of them with $1,500. Okay, that's really interesting, And there's a heap of platforms out there. You've got to supply a heap of details, but you can sort of do it. And I guess there's fees that come with that. Yeah, different fees.
Yeah, brokerage fees.
Okay.
Yeah, admin fees.
All right. And does that come into, not that we want to harp on about it, but kind of like the why and how does it fit into your strategy? Shares versus ETFs versus indexes versus.
That's true. It depends what you want to do, if you want to actively buy or passively buy. Or I think a big difference between the two, as well as the managed fund, you kind of buy whatever you're buying daily.
Okay.
Whereas ETFs, can intradaily, where you can buy down to the minute or the exact price.
Exchange traded, so there's a bit more, they're sort of bought and sold during the day a lot more than, I guess, indexes, which is sort of the end of the day. Okay. Interesting on that one. Okay.
And Yannick, bonds. What are bonds?
Well, I think his name is James. No, sorry. Bonds.
Bravo, that was a good one.
Killed it.
That's your fourth joke, I think, so far.
I've been banned from the jokes for the rest of the day. So bonds are another type of investment. Essentially, there's a few different types. They're like a fixed interest product. Most people out there would have heard of maybe like your treasury or government bonds. and also corporate bonds. So it's essentially you're issuing debt to either. So I'll take a step back. Usually your bigger types of bonds, like your treasury or government bonds, are issued on the primary market. So you and I, or you probably could because you're a big player in that sort of sphere, but we can't really just jump on the share market and buy these as they initially get issued from the government or even some corporations. But on the secondary market, we can kind of buy these, I guess, if that makes sense. But what a bond is essentially like an issue of debt. Sometimes like the government might use them, or the state government might use them to raise money to build infrastructure, and that's how they do it. So a bond is quite different to a share. When you have one share of a company, you have a piece of the pie of that company. If it does well, you do well. You have a co-ownership of that, whereas a bond is just like a debt instrument where essentially you buy a slice and that company or even the state or whatever, depending on the bond, say, well, you've given me $1,000 like a loan. I'm going to pay you back 5% over the next 2 years, or 5% a year over 2 years. At the end of that 2 years, the term of it, you will get your $1,000 back. So it's kind of, that's sort of the vehicle there. Yeah. And it ranges from your big time sort of your more secure treasury and government bonds all the way down to sort of your corporate bonds. And they're all given a different sort of rating on security, viability.
And what if I buy a corporate bond? If maybe it's got a better interest rate than the corporate bond, is that the right thing to do?
Right and wrong. Depends if I'm listening to my left, little devil on your left shoulder, or look, good question on the corporate bonds. No doubt everyone out there's probably got a spam email from some sort of corporate, I guess, real estate development company or private equity firm saying, hey, buy this bond or this fixed term interest thing. And they offer a higher interest rate. So corporate bonds are given, I guess, like a credit rating or a security rating. You would have heard of like AAA is, your big well-known companies. And then you've got your private sort of investment firms that are looking at trying to develop a bit of real estate somewhere, and they're trying to raise capital. Not every company can issue or wants to issue shares, because that means it gives the shareholders a slice of the pie of that company. So they might issue bonds to raise some money to kickstart, say, a development or an investment idea or whatever. The companies will have to sort of entice potential bond buyers with a higher interest rate. It just comes with more risk. Usually, look, as a general rule of thumb, you're going to see some saucy interest rates out there, some promises of, hey, you buy into us with a fixed term security, we'll offer 8.5%. If it's well above what the Reserve Bank of Australia, at the moment, I think interest rates are around the low fours, sort of just know that there are some risks that come with that. Remember, you're buying into a small company. That company could go belly up or it might not.
So I could lose my money if I
potentially
high interest rate.
Yes,
okay.
You can, but just know. But look, as an upside, say you buy a bond for $1,000 and they're advertising a coupon rate of 6%, they'll essentially pay you 6% a year. Sometimes it's a biannual, kind of like an interest payment.
Yeah.
And they might have a term. It might be 2, 3, 4 years. At the end of that term, you usually get your principal back, plus all the interest they've paid you over the years.
Right, so I can dictate the length of time that...
You can. They offered sort of different rates, yeah. So that's another type of investment. And look, same thing. Heap of like super companies, investment companies offer sort of bonds or fixed term securities and stuff to go with it. That's those one. And they're part of, I guess, when we talk about the investment piece, diversification. So, bonds are usually in that defensive side of things, because it's not too often you see a bond, the value of a bond increase. They can, but not like shares. So it's more so it's providing you a consistent interest rate repayment. Sometimes it can be as competitive or more competitive than, say, what a savings account will give you. But that's sort of how that works.
Wow, we got a lot of options there, Yannick.
There's a heaps, and they're only most of sort of like the traditional ones that that are more well known. Whether you're talking to friends at a barbecue or parents or looking on the interwebs, but and they I guess is look, investments are great, definitely, but just know with all those products that are out there, you've just got to make sure that whoever's selling them or offering them is having your sort of best interests at heart. Every fund manager, every entrepreneur, small company, they're all sort of trying to get you to invest in them because I guess they get a little bit of a fee or a commission on the side. So just be cognizant of that.
Yeah.
Yeah, and the same things work when you buy shares. You might be buying shares in Tesla. That's great. You're part of the Musk gang, maybe. But, there'll be a little fee there for buying those shares, whether you have it through your trading platform or a managed fund. You'll have to pay some sort of fee, but it lets you sort of get the skin in the game, I guess, and ride the wave of that one.
And always being wary if you see, something very attractive, usually things aren't, well, they sound too good to be true. They usually are. And just to be wary if someone's coming to you, they're probably coming when their performance or whatever they're selling is at a high point. And maybe just thinking about the long-term effects. You'll keep in mind your goals if you want something short-term, long-term, and doing your research because there is a lot of scams out there as well.
Okay. Yeah. Okay.
Don't mean to scare you, Yannick.
Sweating. Yeah. Okay. No, that's I guess just deciphering who's selling what type of snake oil. I know our snake oil is pretty good. Jessie always spruiks our special snake oil to her clients. It's probably why she's got so many and she only works half a day a week. But anyway, okay. So look, we've covered off a fair bit on, I guess, your traditional sort of investment types, the ones that are a bit more known. Our next episode, we're going to cover off on sort of your alternative ones that have definitely emerged in the markets or as options in the last sort of several years. But I guess you wanted to sort of finish off on someone who's a little bit famous when we
Just
sort of talk about the shares thing.
Yeah. The great Warren Buffett. We just had a couple of quotes that me and Yannick liked.
For all those out there, maybe give him a Google.
He's basically our investment god, isn't he?
Sort of. He's definitely up there. He's worth a fair bit. He's been around just a minute. Maybe I think he's not octogenarian. He's in his late 80s, early 90s now. I think he's 90s.
Yeah.
But he runs a company or give or take called Berkshire Hathaway, massive investment company in the States. He's got some real simplistic, traditional kind of investment philosophies that are really easy to follow. Maybe that's why I like him. He's just easy to follow. Not really technical. He's just got some down-to-earth kind of philosophies and they're easy to follow. Yeah. What are some of them, Jessie?
Well, I'll say mine. I'll let you say yours if that's all right.
Okay.
The problem with active management is that it's hard to beat the market consistently over time. Most managers don't do it, and the ones who do tend to underperform after fees.
Is that going back to what we mentioned, sort of that passive versus active fund manager? Yeah, I think I've seen some of that from him. Yeah, he sort of mentions, show me a fund manager that's potentially outperformed one of those big indexes over a long period of time.
Yeah.
Right. Okay, it's interesting. Yeah, because as we mentioned, active fund managers, I guess they'll charge a bit more of a fee. And when you're talking about investments, we like to sort of talk in, net profit or net growth, which is a big one. It's great if your gross earnings from an investment's, 10 or 20% a year. But when you strip back all your costs and your fees and your all those kind of things, if you're only making 2 or 3% in net profit, well, you could probably be doing better putting your money in a savings account. But story for another time. And I guess, look, one that I've liked and I sort of chat with some clients is time in the market is better than timing the market. So it's kind of consistency over trying to pick the highs and lows of the share market or that sort of buy low, sell high kind of business. Yeah. It's just consistency over time as long as you're willing to sort of wait it out a little bit. And that's sort of prevalent over what's happened the last couple of weeks with the share markets. They've had technically a correction. A few things have dropped by 10%. Some people have hit the panic button. That's the volatility we sort of talked about. We'll talk about that another time. But excellent. Thank you for that quote. There might be a few more that come our way. But
we can't help it. Sorry, guys.
All right, everyone. Stand by for the next episode. You'll hear from us then.
Bye.
Ciao.